Market Pulse and Macro Notes, 9th March 2026, by Value and Momentum Portfolio. Market Commentary and Sectors Review. This past week could be described as a brutal period for U.S. equities. The S&P 500 index fell over -2% measured from Friday close to Friday close. Market valuation has fallen 0.5 times from the 22.0 times peak to 21.5 times. As a reminder, the April 2025 market bottom, an exceptional buying opportunity and current levels are about 5% above it. Investor positioning in the options market is extremely bearish. The S&P 500's 3-month put-call skew is up to approximately 0.50, near the highest in 3 years. The put-call skew measures how much more expensive put options are relative to call options, with higher readings signaling greater investor fear. This nearly matches the levels seen during the 2020 pandemic crash of approximately 0.56. Market performance continues to show a significant bifurcation across sectors. The primary drivers of the S&P 500, financials, consumer discretionary, services, and technology, have reached heavily oversold levels. Conversely, defensive and commodity-linked sectors, including industrials, energy, materials, utilities, and real estate, remain in overbought territory. The primary driver of market volatility is currently the conflict in Iran and its subsequent pressure on oil prices, which remains a critical variable for inflation. The key uncertainties involve the duration of the conflict and the potential ceiling for energy costs. The VIX, a primary gauge of market-implied volatility and investor sentiment, surged 48% last week. While such spikes often signal immediate fear in the market, they have historically served as powerful contrarian indicators for long-term equity performance. Even precious metal stocks failed to provide safety during the recent market decline. While metals rallied in anticipation of the conflict in Iran, they experienced a sharp reversal immediately following the official announcement. This price action suggests a sell the news reaction and supports a strategic approach of taking profits during such rallies. Oil-related equities emerged as a rare bright spot in the market as the closure of the Strait of Hormuz severely restricted international supply. This strategic choke point, essential for approximately 20% of global oil and gas trade, has left Far Eastern economies, specifically Japan, South Korea, and China, facing acute energy shortages due to their high reliance on Persian Gulf imports. Last week, oil prices surged by 34%, the largest weekly gain in decades, creating a formidable headwind for global inflation. This development presents a challenge for global markets. As a primary driver of inflation, rising energy costs simultaneously squeeze consumer purchasing power and complicate the Federal Reserve's policy path. Accelerated inflation effectively restricts the Fed's ability to pivot toward rate cuts, creating a high interest rate environment that further weighs on market valuations. For broader market stabilization to occur, a retracement in energy costs is likely a prerequisite, alongside clear indicators of normalization within the global supply chain. For the coming week, market improvement remains contingent on a cessation of hostilities. Historically, however, geopolitical resolutions are often followed by aggressive equity rebounds. While current indicators have not yet reached levels of extreme exhaustion, we are observing compelling contrarian signals. Notably, net flows into the Nasdaq 100 have turned significantly negative over the past 2 months, a trend that often precedes a market bottom. While we await a definitive extreme fear reading, the market's proximity to these levels suggests that even modest geopolitical de-escalation could serve as a powerful catalyst for a relief rally. Focus on software. The current rotation has become so pronounced that U.S. asset-heavy industrial stocks are now trading at a price-to-earnings premium over asset-light technology firms, a significant historical departure. This divergence was starkly evident last week in the performance gap between semiconductors and software. While semiconductors corrected by 6.4%, the software sector rallied 7.6%, marking a complete trend reversal. This price action validates our recent tactical decision to rotate out of semiconductors in favor of cybersecurity software and e-commerce. From a valuation standpoint, We believe these subsectors remain significantly undervalued and continue to offer a more compelling risk-to-reward profile compared to the broader semiconductor space in this environment. Macro notes on the U.S. economy. While the geopolitical situation in Iran is the dominant market catalyst, the domestic macroeconomic backdrop is showing signs of deterioration. Recent data reveals a troubling disconnect. Inflation metrics are once again exceeding forecasts, while job creation has effectively stalled. This combination raises the distinct specter of a stagflationary environment, where stagnant growth meets rising price pressures. Our analysis of high-frequency data shows a clear split in momentum. While long-term leading indicators remain positive, short-term leading indicators have turned negative, primarily due to the shock of surging oil prices. Consumer and financial conditions. Despite the headwinds, financial conditions and consumer spending remain robust. This resilience stands in stark contrast to recent weakness in retail sales and labor market reports. Corporate profit momentum has slipped from positive to neutral, while mortgage-related indicators continue to provide mixed signals amidst fluctuating yields. Short-term risks have intensified as oil prices approach three-year highs. This spike is already being reflected in commodity indices and is expected to impact retail gasoline prices significantly in the coming weeks. The primary concern is whether the current robustness in coincident indicators, specifically consumer spending, can persist if energy costs continue to erode disposable income. Simultaneously, we are observing significant stress in the private credit market, a sector that has grown rapidly but is now facing its first major liquidity test. We note a growing structural mismatch between the illiquid nature of private loans and investor expectations for periodic liquidity, serving as a warning sign for broader credit markets. Technicals and game plan. We anticipate any potential correction in the S&P 500 to be contained within the 10% to 17% range. This view is anchored by robust corporate fundamentals. Analysts currently forecast 2026 earnings growth to reach approximately 15%, marking a third consecutive year of double-digit expansion. Furthermore, the leadership transition at the Federal Reserve provides a significant sentiment backstop. With Kevin Warsh formally nominated and expected to assume the chair in May, there is high market confidence that his arrival in June will provide the necessary policy safety net to stabilize the financial system. Asset recommendations for this regime. Amidst the current geopolitical instability, we continue to see high conviction opportunities in energy, oil, and defense sectors, which act as natural hedges against regional conflict. Additionally, select technology names are showing resilience, presenting rare entry points for long-term growth. For investors seeking to capitalize on continued volatility or downward pressure, defensive instruments such as FNGD, inverse tech, or UVIX, volatility long, may offer tactical protection in the near term. While financials remain the most technically oversold sector, we are closely monitoring the consumer discretionary space following the recent broad-based sell-off. Specifically, several high-quality names have reached extreme technical exhaustion. Retail and travel, RCL, Royal Caribbean, HD, Home Depot, and LOW, Lowe's. E-commerce, AMZN, Amazon. These stocks are currently trading at deep oversold levels. Historically, these names are highly sensitive to shifts in investor sentiment. Should we observe a rotation back into growth equities, we anticipate these leaders will be primary beneficiaries and likely participate aggressively in any market advance. Upcoming earnings. While the corporate earnings schedule is relatively light this week, the macroeconomic calendar is high stakes, featuring the two most critical inflation gauges in the United States. These releases will be scrutinized for signs of whether recent energy shocks are beginning to bleed into broader price categories. Disclaimer. This report is prepared for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any security. I have no business relationship with any company mentioned in this post, nor do I hold any shares, options, or derivatives in them. I have no plans to initiate any positions within the next 72 hours. This article reflects my own independent research and opinions. I am not receiving compensation for it. Markets are unpredictable, and past performance does not guarantee future results. Please do your own research or consult a licensed financial advisor before making any investment decisions. Investing can be risky and may not be suitable for all investors. All data sourced from company filings, earnings calls, announcements, and publicly available analyst research as of March 2nd, 2026.